This is by far the worst report yet. Now, many of you might not necessarily care about this particular company, but what they say is such a red flag for not only the economy, but also hopefully deflationary pressures to come in the future as consumer spending falls due to the weight of what's being seen. I think it's a report that we ought to look at together. And so I've got the earnings call transcript, and let's get right into it. So this is the nation's third largest home builder. And just take a look at some of the things they say. The very first sentence from the CEO just yesterday is, "We find ourselves delineating between the favorable demand environment that existed earlier this year, which drove the current earnings, versus the more challenging current conditions. As we move through the quarter, you could almost see the ebb and flow of demand with interest rates." I mean, that's not a surprise. And they're finding that people are canceling transactions at a rate that's an increase of 240% of last year. Last year, we were at 10% cancellations during this time. Now we're at 24%. That's an increase of 2.4x, right? And they're finding that people are canceling home purchases for two reasons. One, they can no longer afford a home because of high interest rates, or B, they're unsure if now is the time to buy a home. So that psychology of pain or fear or making a bad decision. And they believe here that because of the Fed's latest commentary about aggressively raising rates to control inflation for at least the remainder of 2022, and then likely holding rates higher for longer, we could see the most significant impact on today's consumers, currently showing up as influencing housing demand. But as soon as housing wealth goes down, we tend to see the entire economy slow down as well. And it's gotten so bad that this particular company is now aggressively discounting their outstanding inventory, aggressively discounting. And they talk about protecting their share within markets, that is how many homes they sell compared to the other home builders. And the way they're going to do that is by not being margin proud. In other words, they're going to dump properties by cutting prices to make sure they can still sell homes and maintain that share of homes for sale. And they're basically dumping out of properties. Not only are they dumping out of properties, but if you look down here, you can see that they canceled $24 million of deposits. You can see that actually at the last line here that's not highlighted, where they say nobody wants to write off these $24 million in deposits. So basically they had deposits on land that they were going to develop, and they said, hey, look, this is about $800 million of land. We don't want to buy it anymore because it's just a bad deal. So we're going to walk away on our approximately 3% deposit, and we're not going to buy that land to develop, to build homes on. That's about $800 million that's not going into the real estate market. That $800 million, guess where it goes instead? And this is where you will always see with real estate companies a divergence between how the stock performs and how the actual underlying company performs. Pulte Homes and a lot of the home builders are finding that their stocks are so undervalued right now that rather than go buy more land or actually go develop more real estate, what they're doing is they're buying back their own stock. Pulte bought back almost 9% of their own stock over since the beginning, since January of 2022, which is absolutely a huge amount. 9% of their outstanding stock bought back. It's crazy how much they've bought back. And they're doing that because they see a better return on buying their own stock than they do on actually buying land right now. In fact, I frequently talk about the 3 wedge deals that a house hack is going to be able to get. House hack is my real estate startup. Number 1 wedge deal is where you buy real estate below market value because you're buying fixer-uppers and you're fixing them up at a lower price than what anybody else can. That's kind of like flipping homes, but we're not home flippers. We're doing long-term rentals and short-term rentals. And so that's wedge number 1, is buying a good deal. That's how you make money by, let's say, buying a $500,000 home in, say, a $700,000 neighborhood, putting in $50K of repairs. You're up $150,000, right? That's wedge number 1. Wedge number 2 is selling parts of the portfolio while retaining management and some of the upside to pension funds who are looking for cash flow. That's the second way that house hack can get a wedge deal. And the third way you can get a wedge deal is by buying your stock back at a discount when the market is panicking. And that's what the home builders are doing. It's actually smart, and it's a tax efficient way of increasing shareholder value. Anyway, so with the current dramatic and ongoing interest rates likely being the biggest concern for most consumers, and other factors at play, including inflation, fear of recession, or increasing concerns about job loss. Like, this is just an all-around, on one hand, bad report, but on the other hand, I hope the Fed reads this report and they're like, yes, spend less money. Consumers, spend less money. Be worried. Be fearful about inflation. Be fearful about recession. Be fearful about job loss. Please. Now, they talk about having a more defensive posture for the near term. They talk about having 28% fewer orders. And what I found interesting was that first-time homebuyers actually represented 3% more of their home buyers. In other words, people who generally put very little money down, like 3 or 5% down, so they're borrowing most of it, which means, sure, they apparently have the salary to qualify, but they don't need a lot of a down payment. And the older move-up buyers are buying at a 45% reduced rate, probably because they're like, yeah, no, been through a housing crash before, ain't doing it again. The first-time homebuyers haven't. Oops. Anyway, let's see here. Homes under construction. Okay, let's see. Higher financing incentives. This is just a way that they're hitting their margins, trying to dump these properties. Oh, this was fascinating. Look at this. Given the change in buyer demand and the resulting impact on the turning of our own land, we currently expect that our land spend will drop materially next year. Now, that I thought was really interesting, because what they're actually, and here's that 9% buyback at the top. What they're saying here is, hey, look, we haven't like actually fully hit the brakes yet. And this is kind of something that you saw at Google as well, where Google's like, yeah, look, we're getting reamed, we're down like 8% today, and we hired way too many people, and we're trying to refine our focus. We kind of lost our focus and hired too many people, but hiring will slow materially in Q4 and next year. And I'm like, damn, folks, we've known about this disaster coming since January, and you're just now refining. And so I think it's interesting how long everything takes. Honestly, that's probably been one of my biggest lessons of this cycle is it doesn't have to go fast. Just because I expect the Fed to rug pull us and go dirty doesn't mean the bottom of the market comes soon. It could come years later. And we expect that for real estate as well. The bottom of the market, at first I thought it was going to be Q2 of 2023. Now I think it'll be more like Q3, Q4. And maybe when we get to Q2 2023, I'll be like, damn, the bottom of the real estate market might not be until Q1 of 2024. I don't know. But I will say everything's taking way longer than expected. It's lasting longer, and it's been a lot harder than expected. And you're seeing that in these earnings calls as well, where companies are actually just now really starting to cut back. It's crazy. So let's see what else we have here. While we expect the coming quarters will be difficult, they're still positive and bullish in the long term. That is, people buying homes in the long term, of course. And remember, generally, home ownership rates decline during these housing crashes. So it's a great opportunity for investors to increase their market share, which is unfortunate for individuals trying to get in, but that's just the way it is. Talk a little bit about market share here with incentives, interest rates. Okay, here we go. 35% is spec. That's not so interesting about the market. Average selling prices are coming down with margin consequences. Trying to give you the juiciest here. Yeah, so they talk a little bit about their $24 million write-down, how that would have represented $800 million worth of properties. That is land that they would have bought. What else is interesting is they talk about here how you saw a little bit of a dip in rates in August. And this is true. We did see a dip in rates in August. And we saw some activity around then where people came off the fences. But then rates went higher again. In fact, if you jump over to this PDF I have, which actually has the 10-year Treasury listed right here, you can see that this green section right here is approximately where August is on the 10-year Treasury. And, August ended at 3.26. Well, we're at like 4% now. So we're way higher. I mean, mortgage rates are now at an over average of 7%. It's quite remarkable. So then look at this one here. In many cases, their buyers are walking away from sizable deposits, which they say doesn't even make a lot of sense because they're potentially walking away from these deposits that are so large that it's like, dude, like even if prices went down 10%, you just lock that in by walking away from your deposit. And this is where, I mean, that's just an example. Generally, people put 3% down as a deposit, but just as an example, because that's the argument they're trying to make here. But then they say, but that's where you really get into the psychology. Yeah, I mean, just like the courses I have on building your wealth, they're designed for the psychology of money, both real estate negotiations, property management, stocks, investing for the long term, right? That's what they're all about. You'd use that Halloween coupon code down below. We'll be going live in a course member live stream after this, going through some more important earnings calls. But boy, oh boy, when you start talking about companies going, man, the psychology of our customers is really changing, that's when you know we have more pain coming. And it's just beginning. And they do mention that some of the areas that are doing the best, and this is very important for HouseHack. Remember, if you're an accredited investor, make sure you go there to househack.com. That they're really focusing on areas with attractive job growth and warmer weather, attractive climates, which they suggest are the Sunbelt region, so like the Southeast and Florida, Texas. Very interesting. And so you are actually seeing those areas right now at least get hit less than you are West Coast areas, even though West Coast areas have better job or a better climate. It does seem like job growth is going towards the Southeast and the South. Anyway, they also notice, look at this, folks, trades, right? Plumbers, electricians. Those are the trades that are feeling the slowdown in the industry right now. The front-end trades, like underground plumbing, blah, 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 blah. In other words, when tradespeople start feeling the slowdown, what does that mean? Recession, folks. One person's spending is $5 of somebody else's spending. And it's just now slowing. This is crazy that 10 months after I made my January videos about the Fed forcing a recession, we're just now seeing companies like, yeah, now we're slowing down. Now we're canceling purchases. Now we're slowing hiring. And they're not even at that max level of slowing down yet. They're so slow and not nimble. It's scary. Anyway, if you're scared, get life insurance in as little as 5 minutes by going to mackevin.com/life. Check out the programs in building your wealth. And folks, see you in the next one. Good luck.